So in a real estate closing, what do they mean when they say prepaid closing costs? Well, first of all, folks, a prepaid closing cost in general is an expense that's going to increase what a buyer or borrower needs to bring to the closing table. And these are expenses that are paid up front. They're prepaid. What are some of the typical prepaid expenses that you might see in a closing? Well, first of all, there's prepaid interest. Now, prepaid interest is basically the mortgage interest that you're not paying in your first mortgage payment. And so what do I mean? I give you an example. So let's say we're closing in the middle of October, October the 15th, just to pick a date. When you close on that day, your first payment typically skips a month. So the month of November would be typically skipped. And your first payment on a closing that happens in October, or October the 15th, would be December the 1st. Now, when you make a December the 1st payment, you are actually always paying for the month before. So when you make a December the 1st payment, you are paying for the month of November, principal and interest. Your first payment in December covers the month of November, the month before. Now, remember, we closed, in our example, on October the 15th. So your principal and interest for the month of November is covered in the first payment in December, but October still has to be accounted for. Remember, the bank charges you what we call per diem or per day interest every day that you have the loan out. So just in our simple example, you would have 16 days worth of interest that still remains in the month of October. That would be your prepaid interest in this example. So that's one of your prepaid expenses. What else do we usually discuss when we talk about these types of expenses at the time of closing? Well, the next thing that comes to mind would be escrows. When you escrow for both your taxes and insurance in general, these are considered prepaid items. Once again, the expenses that are going to drive up what you need to bring to the closing table at the time of closing. So when you, let's take one of those things, homeowner's insurance. You're going to escrow for your homeowner's insurance. And so what an escrow account typically does, what I usually say to borrowers is, think of an escrow account like a forced savings. And so for your homeowner's insurance, what your bank is going to make you do, a lot of times, is they will make you pay your homeowner's insurance through your mortgage payment. And the way that they factor that into your mortgage payment is they take your premium, they divide by 12, and then they'll take a couple of months. So divide by 12, you get 1/12. They'll take a couple of months of escrows up front to establish your escrow account. And so then what happens is every month that you make your payment, 1/12 of your homeowner's insurance would go into the escrow account so that by the time 12 months rolls around, there'll be enough inside your escrow account and the bank will pay your premium at that time. So it's once a year for your homeowner's insurance and you save it up every month until you hit the 12-month period. Now take that concept and apply it to your real estate taxes. Same idea, folks. So with your real estate taxes in your escrow account, once again, what the bank is going to do is going to take the full tax amount for the year and divide by 12. And your escrow accounts, once again, will capture that 1/12 payment every time you make your mortgage payment. Now, in Massachusetts, just about all of your cities are quarterly. So 4 times a year, they'll be making real estate taxes, right? Real estate tax payments. And the invoice will come out 4 times a year. And the bank, once it's collecting that 1/12 payment, will automatically make the payments for your real estate taxes. Now, if you're escrowing for both your taxes and your insurance, why then will the bank make you pay your homeowner's insurance sometimes in advance, 12 months in advance? And why will sometimes the bank make you pay your real estate tax bill in advance? Well, when it comes to homeowner's insurance, once again, this is a prepaid item. Now, you're going to pay for the immediate 12 months that you're going to have your home or that you're going to insure your home. So the first 12 months has to be paid for in advance. That's why the bank is going to make you pay your 12 months in advance at the time of closing. And then they'll establish the escrow account for down the line, for the 12 months following your initial premium payment. Now, when it comes to real estate, the same concept. The bank is going to be escrowing for the future, for future real estate tax payments. But if you have, in general, a real estate tax bill due right around the time of your first mortgage payment, let's give us our example again. Our first payment was December the 1st. Well, typically in Massachusetts, your second quarter is November of every year. And so you will have a payment due before your first mortgage payment. If that's the case, the bank is going to make you pay that November bill at the time of closing to clear the slate, folks, so that the escrow accounts can pick up down the line. So those are some of your typical prepaid items that you will pay at closing. Now, there are other things that you have to take into consideration, especially if you're buying real estate. There will be prorations for real estate taxes, for condo fees if you're buying a condo. If there are tenants involved, there'll be prorations for rent collections and deposits. Deposits will be transferred oftentimes at the time of closing. Now, when it comes to proration, what I usually say to folks is, if you are paying an expense at the time of closing or prior to the time of closing, then typically you are going to receive money back for that expense that you paid. So, for example, if a seller pays the real estate taxes in advance, we closed, remember, October the 15th. If the seller paid the real estate taxes in advance, then the seller will be due money back for that quarter. Remember, it's every 3 months. Same, likewise, if the seller collects rents prior to closing. My general rule is if you collect money prior to closing, you have to give it out. So if a seller collects rents prior to a closing, they're going to have to prorate the rents back to the buyer. They're going to have to give some of that money back because the seller's only responsible for the expenses up until the time they transfer the title to the property. So anything above and beyond that would have to come back to the seller. And likewise, the seller is only entitled to the income up until the time they transfer a title. So if they collect money, then they've got to prorate it back to the other side. Now, I have included in the description below or above if you're on Facebook some of my prior videos about these prepaid costs at closing. They're meant to be short and definitions to help you understand the concepts even better. Make sure you check those out. Now, if you're watching me on Facebook, make sure you subscribe in the lower right-hand corner. Some of my videos will be appearing up here. There'll be a list in some of my prior videos to help bring home some of these concepts. Dave Ceruolo, CeruoloLaw.com.